Hello and welcome to this video about 401 Same As An IRAs. These are both retirement savings plans that can help you build a nest egg for your golden years. But what exactly are they, and how do they differ? Let's dive in and find out. What is a 401? A 401 is a type of retirement savings plan that is offered by many employers in the United States. It allows employees to contribute a portion of their pre-tax income into an investment account that grows over time. The contributions are tax-deductible, which means that employees don't pay taxes on that money until they withdraw it in retirement. The money that is contributed also grows tax-free, which can help the retirement savings grow faster. There are limits to how much employees can contribute each year, and these limits are set by the Internal Revenue Service. For 2022, the contribution limit for employees under 50 is $20,500, while those over 50 can contribute an additional $6,500 as a catch-up contribution. Employers may also contribute to employees' 401 accounts, and this contribution can be in the form of a matching contribution or a profit-sharing contribution. A matching contribution is when the employer matches a portion of the employee's contribution, up to a certain percentage or dollar amount. For example, an employer may offer a 50% match up to 6% of the employee's salary. This means that if the employee contributes 6% of their salary, the employer will contribute an additional 3%. A profit-sharing contribution is when the employer contributes a percentage of the company's profits to the employee's 401 accounts. The contribution is usually allocated based on the employee's salary or tenure with the company. Employees have some control over how their 401 contributions are invested. The investment options may include mutual funds, exchange-traded funds, stocks, and bonds. The fees associated with investing in a 401 can vary, and it's important for employees to understand these fees and how they can impact their retirement savings. One of the benefits of a 401 is that the money that is contributed is protected from creditors in case of bankruptcy. However, there are restrictions on when employees can withdraw money from their 401 accounts. Generally, withdrawals before the age of 59.5 are subject to a 10% early withdrawal penalty, in addition to income taxes. When employees reach the age of 72, they must start taking required minimum distributions from their 401 accounts. This means that they are required to withdraw a certain amount each year based on their account balance and life expectancy. RMDs are subject to income taxes, and if employees don't take them, they may face a penalty of 50% of the amount that should have been withdrawn. In summary, a 401 is a retirement savings plan that is offered by many employers in the United States. It allows employees to contribute a portion of their pre-tax income into an investment account that grows tax-free. Employers may also contribute to employees' accounts, and the investment options can vary. While there are restrictions on withdrawals and RMDs, a 401 can be a valuable tool for building a nest egg for retirement. Is a 401 the same as an IRA? No, a 401 is not the same as an IRA, although they both have some similarities. The main difference between the two retirement savings plans is who can offer them and how much you can contribute each year. A 401 is a retirement savings plan that is offered by many employers in the United States. If your employer offers a 401, you can contribute a portion of your pre-tax income into an investment account that grows over time. Many employers also offer a matching contribution, which means they will add money to your account based on how much you contribute. The contributions you make to a 401 are tax-deductible, which means you don't pay taxes on that money until you withdraw it in retirement. The money you contribute also grows tax-free, which can help your retirement savings grow faster. However, there are limits to how much you can contribute each year, and there may be fees and restrictions on how you can invest your money. An IRA, on the other hand, is a type of retirement savings plan that is not tied to your employer. Anyone can open an IRA, regardless of whether they are employed or not. There are two main types of IRAs, traditional and Roth. A traditional IRA works much like a 401, in that your contributions are tax-deductible and your money grows tax-free until you withdraw it in retirement. However, there are income limits to how much you can contribute each year, and you must start taking required minimum distributions at age 72. A Roth IRA, on the other hand, does not offer a tax deduction for contributions. However, the money you contribute grows tax-free and can be withdrawn tax-free in retirement. There are also no RMDs for Roth IRAs, and there are no income limits on contributions. Another difference between 401 Same As An IRAs is the contribution limit. For 2022, the contribution limit for a 401 is $20,500 for individuals under 50 and $27,000 for individuals 50 and older. The contribution limit for a traditional or Roth IRA is $6,000 for individuals under 50 and $7,000 for individuals 50 and older. One final difference is that a 401 may have additional fees and restrictions on how you can invest your money, whereas an IRA may offer more flexibility in terms of investment options and fees. In conclusion, While a 401 and an IRA share some similarities in terms of tax benefits and investment growth, they differ in who can offer them, contribution limits, and investment options. It's important to consider your individual circumstances and goals when deciding which retirement savings plan is right for you. Consulting with a financial advisor can also be helpful in making an informed decision. Which one is right for you? Deciding whether to invest in a 401 or an IRA depends on your personal situation. If your employer offers a 401 with a matching contribution, it's usually a good idea to contribute at least enough to get the full match. Beyond that, you'll need to weigh the investment options, fees, and other factors to determine if a 401 is right for you. If you're self-employed or your employer doesn't offer a 401, an IRA may be a good option. You can choose between a traditional or Roth IRA based on your tax situation and investment goals. In summary, a 401 and an IRA are both retirement savings plans that can help you build a nest egg for your golden years. While they have some similarities, they differ in terms of contribution limits, tax benefits, and other factors. Ultimately, the best choice depends on your individual circumstances and goals. So, make sure to do your research, consult with a financial advisor, and start saving for your retirement today. That's it for today's video on 401 seconds in IRAs. We hope you now have a better understanding of what these retirement savings plans are, how they work, and how they differ. Remember, saving for retirement is important, and it's never too early or too late to start. So, take some time to explore your options, weigh the pros and cons, and make a plan that works for you. Thanks for watching. And don't forget to subscribe for more financial education videos.